temporada de resultados empresariales, comenzando por los bancos. Vamos a hablar de todo ello con Jay Pelosky, es fundador en TPW Advisory. Jay, thank you so much for having us a few minutes. Good afternoon from Spain.
Hi, Martha. Happy New Year.
Happy New Year. Well, Jay, the U.S. labor market remains strong despite inflationary pressures, and we saw last week two key employment reports. We saw how unemployment rate, slightly fell to 3.5%. Do you think is the Fed likely to maintain a hawkish approach during almost the first 2 quarters of 2023?
Well, Martha, I think the markets have certainly gotten off to a good start this year. The jobs number, while you say was strong, I think I would characterize it kind of more in the direction of where the Fed would like to see it, namely job growth continuing to decline. A year ago, we were averaging 600,000 new jobs per month. 6 months ago, we were averaging 400,000 new jobs. Now we're averaging roughly 200,000 new jobs and probably on our way to 100,000 new jobs a month, which is the Fed's target. So as we are doing with inflation, we're getting much closer to the objectives the Fed would like to see, and that's what the market is reacting to, bonds rallying, the US dollar weakening, and stocks rallying. So I think depending on what we see with the inflation number on Thursday, that number will have a big impact on what the Fed ends up doing at the end of the month, beginning of next month. My own view is that the Fed, it's either going to be a 25 basis point hike, so a step down from the 50, which was itself a step down from the 75 basis point hikes that we had 4 times in a row, unprecedented in U.S. modern economic history. So a step down to either 25 basis points or perhaps no hike at all, depending on what the CPI report looks like on Thursday. But right now, I would expect 25 basis points and then expect the Fed to go on hold, pause indefinitely. We think that pause could last throughout this year. We do not yet see the scope for rate cuts, which is priced into the market currently. And right now, on that note, Fed Fund Futures is suggesting a 28% chance of 50 basis points, down from almost 45% chance pre the jobs number. So that suggests that the majority expectation is for 25 basis points of a rate hike at the next Fed meeting.
5 basis points is the main bet right now. You mentioned the December CPI that we will know this week, this Thursday. This week, as you said, this is a new important data that we will see. What do you expect about inflation and core inflation? Any surprises?
Not really a surprise, Martha. I think the consensus, and we at TPW Advisory agree with the consensus that inflation will continue to decline. I think the consensus is for something on the order of 6.5% headline, down from 7.1%, and core going from 6% to 5.7%. What we're watching here at TPW Advisory is the month-over-month inflation reading. And that looks like it's going to come in at either 0.1 or 0.2% month-over-month increase. And that puts the last 6 months, so the second half of 2022, inflation would be averaging roughly 2%, slightly more than 2%, because the readings have been in that 0.1 to 0.2 point range. And so it suggests that the current trend of inflation is very much in line with what the Fed expects. And that has been our view for some time. We've been of the view that inflation is going to surprise and decline faster than expected. And we think that if we get that 0.2% reading or 0.1% month-over-month reading, then that will suggest, again, 6 months worth of data, not just 1 month, but the last 6 months averaging 0.1 or 0.2% month-over-month, suggests that inflation also has stepped down significantly. And we think that's what's going to give the Fed the room to either kind of signal that 25 basis point with a pause going forward. That's kind of the outlook, and that month-over-month inflation print, that's the detail that we're looking to watch and looking to see confirm our expectation of a continued decline in inflation.
And by the way, Jay, this week we will have part of our attention in the next earnings season. We'll start this Friday with banks, Wall Street banks. They will be the main characters, we could say that. What do you expect about this new earnings season? Because we are talking about the last quarter of 2022, and we are seeing how a lot of analyses are not really optimistic about it.
Yes, I think that your characterization, Martha, is correct. I think consensus is calling for about a 4% decline in earnings year over year. So that would be the first, I think, year-over-year decline in some time. But the interesting point to us is that net revisions, so the number of earnings upgrades versus downgrades, over the last several weeks, the net revisions number for the U.S. has been trending up. So there's a lot of negativity in the markets, in the sentiment, in what people are forecasting, whether it's recession in 2023, right, the most predicted recession in history, or whether it's a collapse in earnings driven by that recession, which is going to take the S&P down another 15 or 20%. That's the operative mindset of the consensus going into 2023. I think, and we think at TPW Advisory, that's going to be wrong. We have been talking about nominal growth supporting the top line or revenue numbers, and that also supporting the bottom line. So if consensus for Q4 is already at -4% year over year, we think that's a low bar. In other words, earnings should be able to do better than that as we go through earnings season. But we're more interested, again, like with the inflation number, it's not just the headline or even core. We're looking at the month-over-month comparison. In earnings, we're really looking at the year ahead. We want to see what companies are talking about and what their expectations are for 2023. And there, the consensus is for positive earnings growth in the U.S. of about 4%. So there's a big distinction going on, or difference, between the bottoms-up sector analysts who are relatively confident or relatively comfortable with some earnings growth next year, and the top-down strategy call, which most of the strategists on Wall Street are calling for a decline in earnings and a decline in the S&P. We're more in the camp with the analysts. We expect earnings growth to be plus 5% seems reasonable, and kind of a flattish S&P for 2023. We don't expect recession, and therefore we don't expect the big drop in the S&P that, again, is consensus. Our view is a flattish S&P, which sets up perfectly with a weak dollar to have the non-U.S. equity markets outperform. And we think that's the really big call for 2023, is that non-U.S. markets are going to continue to outperform the U.S. as they did in 2022, which is a story that hasn't gotten anywhere near the attention we think it deserves.
Well, Jay, thank you so much for this analysis. As always, a pleasure.
Okay, Martha, take care. Bye-bye.
Nos quedamos, por tanto, con esta fotografía general